To share her insights about the local market outlook, let's welcome to the stage COL's Chief Equity Strategist, Ms. April Lynn.
Good morning, everyone, and thank you for coming to our market outlook this Saturday morning. Okay, so, I went on a vacation earlier this July, and when I came back, one of the first headlines that I bumped into is the bull market. The Philippine stock market is in a bull market. And as of last Thursday, when I made this report, we were still in a bull market because we're up by more than 20% from our November low. Okay? And, I guess the question is, what are the reasons why we are in a bull market? And definitely, there are plenty of reasons domestically. To summarize it all, I think the first and most important thing to talk about is the reversal of factors which pulled the market lower in 2018. So first of all, we have inflation. So as Asek Lambino talked about inflation a while ago, you can see how, inflation after going up substantially last year to a peak of 6.7%, it's now down to 2.7%, which is the blue line there, the dark blue line. But then I think more importantly, you should look at the light blue line and the orange line, which are food inflation and transportation inflation. Thankfully, food prices have gone down substantially after going up a lot last year. So the price of rice in particular is actually now lower compared to last year. And oil prices have gone down, which have also reduced transportation costs. So these are the two most important factors driving inflation lower. And for the rest of the year, the next few years, I think people are now very confident that we will stay within the 2 to 4% ideal range for inflation. And because of the lower inflation, our 10-year bond rate, which last year spiked up all the way to 8.3% in October, is now back to 4.7%. In fact, 4.7% is even lower than where we came from during the start of 2018. So this is really very good for us, okay? And another factor last year, which caused a lot of concerns among investors, is the weakening of the peso. So if you can recall, last year, the peso hit a peak of 54.33. And a lot of people were really concerned. I mean, I can remember last year, a lot of Filipinos are thinking, it's a deja vu. I remember the time when I was young and when people had money, one of the first priorities they had was buying US dollars. So last year, a lot of people were thinking, if I have money, the best investment will be buying US dollars. And that was the sentiment last year. But for this year, you can see how the peso has actually appreciated and stabilized. And it's now at the 51 level. And occasionally, it would hit the 50 level. And, I think the urge to continue buying dollars is no longer there, which is good. And then finally, last year, we talked about how foreign investors just wanted to sell the Philippines. They didn't care what we had to say or how good the economic growth was. As far as they were concerned, the US Fed is raising rates, the US dollar is strong, therefore we have to be in the US. We should sell Philippines and all other emerging markets. As you can see here, the trend has reversed. Foreign investors are actually coming back in the Philippines, which is good. Okay, so talking about the US Fed, the thing is, from the start of the year, the good news is their policy has reversed, or the Fed from being hawkish to now being a very dovish Fed. So if you recall, in December last year, after raising rates for the fourth time, the US Fed or Powell actually hinted in January that, okay, I think we need to be on pause. We're not going to raise rates anymore. And then finally, in June, he hinted a possible rate cut in July. So, the Fed being dovish is actually good for the Philippines because it actually gives our central bank more space to cut rates. Okay? And, that said, earlier this year, I moderated a panel among economists in one CFA event. And during the start of the year, everybody was thinking, okay, we're not gonna have any rate cuts. Or domestically, there will be no rate cuts. There will only be a 200 basis point triple R cut or reserve requirement ratio cut, or the percentage that banks set aside with the central bank. That will be reduced by 200 basis points. But all economists across the board said, no rate cut is gonna happen. Okay, but today, as of this day, the BSP has actually reduced our interest rate by 25 basis points, reduced the triple R by 200 basis points, and Governor Diokno has implied that there would be a possible 25 basis point rate cut again this August or as early as August, and going forward, potentially more triple R cuts or reserve requirement ratio cuts. So you can see how our central bank policy is again more dovish thanks to the US being more dovish or more accommodative, and of course, locally, inflation being much lower than it was last year. And risk factors domestically are a lot less. So first of all, I would like to highlight the passage of the government budget. So if you were here last January, I talked about this as being one of the key risks. We didn't know whether the budget would be passed or not. But in April, it was finally passed, and this should help economic growth pick up in the second half of the year. And then another risk that we saw, which we didn't anticipate earlier this year, was the inversion of the yield curve. Meaning, the 10-year rate is actually lower than the short-term rate. Now, I'm sure for those of you who have time deposits in banks, you are aware of this. Okay? Pag magta-time deposit kayo ng 30 days, di ba mas mataas kaysa sa 60 or 90 days? So yan yung definition ng inversion of the yield curve. When you want to save for shorter term, mas mataas ang rates. Kaysa you want to invest longer term. Pero di ba normally, dapat pag mas matagal kayong mag-invest, mas mataas ang rates kasi may risk ng pagbabago. So essentially, what has happened, the reason why the yield curve in the Philippines became inverted or baliktad is because the banks are really very tight yung liquidity nila, di ba? Wala silang pera in the short term kasi nga yung triple R natin or the reserve requirement ratio or the amount that they have to set aside with the BSP is very high at 18%. Okay? And then the loans to deposit or amount of loans that they have lent out is already at more than 80%. So ibig sabihin, kailangan na nilang umutang para makapagpautang sa iba. Okay? So with the reduction of the triple R, for those of you na nag-roll over na mga time deposit, you will notice bumababa na siya. Di ba? Yung mga deposit rates. And the BSP actually has room to cut the triple R still at this point. So hopefully, they keep on reducing this para yung yield curve natin hindi na mag-invert at mag-normalize na siya. So that would really help the banking system, no? Okay, and in terms of valuations, the good news is although we are in a bull market, the market has gone up by more than 20%, we are still trading at very good valuations. Okay, so if you look at this PE band, the past 5 years, it just says that if you're trading at the lower end, it means you are cheap relative to where you were the past 5 years. This is essentially where the market was trading most of the time. On the low side, we were trading at 16 times PE. On the high side, we were trading at close to 19 times PE. And despite the market going up substantially, we're still trading at only 16.9 times PE, which is a very reasonable level, meaning hindi pa mahal ang stock market. And another way which we look at it is, comparing each and every member of the PSEI. Because, we always argue, kasi daming mga critics yung mga sobrang bearish sa stock market are saying, no, 5 years is not the right way to look at it. And also comparing the Philippines, 16, 17 times. If I compare it regionally, that's a very high level. So what we did is we just got each and every member and, took a look at what their PE levels are. And just to make it uniform, we compared it to their average and whether they're trading above average or below average the past 10 years. And if you can see here, although now we have more stocks that are trading at a premium relative to their average PEs, which is the zero line, there are still quite a lot of stocks that are trading below it. I would say 2/3 are still trading below their historical average PEs. So marami pang mapagpipilian at this stage. No? Our market is not expensive at all. Okay, so that's it. So first the good news, now the bad news. The bad news though is, looks like, our markets are gonna stay volatile. My feeling about this bull market is parang bullish ka one day, then bearish the next, no? That's the feeling I get. And the bad news is, this feeling will most likely stay in the short term. And one of the reasons for it is the poor economic outlook globally. So I was thinking of what to show you, but I think the two most important factors to highlight would be how the manufacturing PMI is doing, okay, or the purchasing managers index. So they do a survey of the purchasing managers. So this is a global PMI. This is not only Philippines or US. But anyway, most countries around the world have a PMI that is below 50. So the most important number to remember here is 50. If it's above 50, ibig sabihin, the manufacturers are very bullish and they're going to grow. If it's below 50, it means they're pessimistic and they're not going to expand. So you can see how it's actually right now below 50. It's not only going down, it's below 50. So the outlook is very negative. And I'm sure for those of you who follow the news, you are aware that Germany came out with a more negative PMI, di ba? Bumaba pa siya even more, below 50, so it was really bad. And next is the global business confidence. Okay, you can see as well how it has also deteriorated significantly. And the main reason why business confidence is very poor is because of policy uncertainty. So first of all, you have the ongoing trade tensions. I mean, it's not only US and China, it's also US changing its policies towards its other trade partners around the world. And then in Europe, you have Brexit. So if you're a businessman and you're thinking about expanding, most likely you will think, I will stay on the sidelines and wait until what the final policy is. At least I have more certainty of what to expect. No? Kung wala kang confidence, hindi ka rin gagastos, di ba? Let's wait for things to settle down and be more certain before we actually start to spend. So really, the global outlook is quite, uncertain at this stage, which for me is one of the key risk factors. Okay? So the good news, though, is despite this, the central banks have become very much aware of the problem of global economic growth and have become very accommodative. So it's not only the US na from a rate hike now into a possible rate cut, even Europe. Europe just ended the QE last December, but just this week, it talked about the possible resumption of the quantitative easing and they may actually even start cutting rates again. And to think they're already at negative, they might cut it further in September.
Okay, Bank of England said they're ready to cut rates assuming a no-deal Brexit materializes. Bank of Japan said they are ready to cut rates even further and increase the asset buying to achieve the 2% inflation target. And even Bank of China said we have a lot of tools to deploy if the trade war worsens. Okay? Philippines, things are great, except, last year, di ba, ang ganda-ganda na economic growth. Bakit ganyan, di ba? Bakit? Ano bang pinoproblema ng mga economists? And people kept on highlighting the twin deficits. So what are these twin deficits? The budget deficit and the current account deficit. And the bad news is, looks like they're here to stay. The budget deficit, the ceiling was maintained at 3.2%. So the next few years, the bad thing about spending a lot on infrastructure is we will have a budget deficit, And another bad thing about spending a lot on infrastructure is the current account deficit. Okay, so for this year, despite the slowdown in the first half, the BSP is saying, we will still have a current account deficit of 2.8%. Okay, so the bad news is, with these two numbers, the risk is the peso will weaken again. And unfortunately, although a weaker peso is not bad, foreign investors view it negatively because, of course, when they buy Philippine stocks and the peso weakens, their portfolio value goes down. Okay, so this may come up as another risk factor going forward to hurt the Philippines. And we have other near-term risk factors. So this August will be the third quarterly MSCI rebalancing, and the MSCI emerging markets already announced that the weighting of Saudi Arabia and China will be increased. And if you recall, last May, because of this, the stock market went down because foreign investors who are tracking the MSCI Emerging Market Index had to sell some Philippine stocks to make way for higher weighting of Saudi Arabia and China. So we may see a repeat of this in August. And again, in August, we may see some companies delivering somewhat disappointing earnings because, again, we had a delay in the passage of the budget, okay? And because of that, we are bracing for a potentially weak second quarter period, at least for GDP growth. So because of that, we may continue to see some companies coming out with weak earnings in the second quarter. And we know the knee-jerk reaction is if a company comes out with the weak earnings, share price might go down, at least in the short term. Okay, here's my sector outlook. What do I think? So I'll start with the sectors that I like. So I like three sectors right now. I like the property sector, I like the banking sector, and the airlines. So for the properties, property stocks will be major beneficiaries of lower interest rates. Of course, lower interest rates will mean more affordable property purchases for buyers. Next, leasing rates are now going up. Offices are very positive because of strong demand from POGOs, from BPOs, and even from traditional businesses. We're seeing demand across the board. And finally, we still have some property stocks trading at attractive valuations. For the banks, again, actually, if you have been investing in banking stocks, you have noticed how weak they have been during the first half because of the inversion of the yield curve. But now that the yield curve has reversed and normalized, we think that it's time for them to catch up. Okay, aside from that, the lower interest rates are resulting to higher trading gains. So yesterday we had Metrobank and BDO releasing their earnings, and they actually announced very strong trading gains. So we'll see more of that for the banks with lower rates. And finally, the valuations of banks are very attractive relative to their historical. You will notice actually the average price to book value of banks right now is 1x price to book value, which is very cheap. So we feel like there is some opportunity for the banks here. Okay, then the next sector that we like is the airlines. First of all, demand is very strong for travel. And next, they're benefiting from falling oil prices and, of course, the stable peso because a lot of their cost is oil and dollar denominated. Okay, sectors which I feel have a more neutral outlook would be consumer sector and cement. Okay, for the consumer sector, the lower inflation, higher government spending should boost consumer confidence. So consumer confidence in the Philippines is actually turned negative last year because of high inflation. So in other words, walang gana gumasto sa mga consumers, despite the fact they're actually wealthier today than they were before. Parang yung mga businesses, di ba, walang gana. Pati consumers, walang ganang gumastos. Pero we think that should reverse soon with inflation going down and government spending picking up. Okay? And of course, for consumer companies, their cost to produce is lower because of falling commodity prices. The bad news is second quarter, baka pangit pa yung earnings. So medyo wait lang tayong konti. No? Or there might be an opportunity for us to pick up consumer stocks at cheaper valuations. Okay, for the cement sector, we're seeing or we're anticipating growing demand because of infrastructure spending. And then recently, the government imposed safeguard duties on imports to actually make local cement more competitive from cheap imports. And power costs this year will be lower thanks to lower coal prices. Okay. The problem is second quarter earnings again could disappoint because of the construction ban that was implemented because of elections and delay in the passage of government spending. Okay, other neutral sectors, telcos and power. So sa telco, actually things are looking better for the telcos. Earnings are reversing. They're finally in a steady growth path. Okay, since data is now more than 50% of revenues. Okay, the problem is they have to spend a lot on capital expenditures because demand is so strong, they need to catch up. And the sentiment is being hurt because of uncertainty of how the third telco will affect them. Okay. Then finally, power sector. Power sector is benefiting from lower fuel costs, lower coal prices. Valuations are also attractive at this stage. However, in the short term, there still is an oversupply, and this means their inability to sell their power at a high price, and they're having a hard time expanding because there is an oversupply, at least in the short term. So negative outlook, sectors with negative outlook. The gaming sector has a negative outlook at this point. So there will be two factors that will hurt them. First, the slowdown in the Chinese economy is hurting the VIP gaming sector. And also, just recently, the government is no longer allowing proxy betting. So that will actually hurt the operations of a lot of the casinos here. Okay, so going to our stock picks. So on a monthly basis, we actually come out with our views on the market. So we have the Calling the Shots report, and we come out with our favorite stocks. So as you can see, for those of you who actually follow that report, it's pretty much the same. But there have been two additions recently. Actually, we added one stock today, and last month we added another stock. So last month we added Philinvest, and this month we added CNPF. So I'll just be talking about these two stocks in the interest of time. Okay, Philinvest. So we added this stock last month. And the reason why we like Philinvest is because we feel like it is a re-rating play, meaning this company has evolved and changed itself, and it's now an integrated company from being a pure property developer, because the leasing business or office rentals and malls now account for 46% of profits. In the past, this was a pure residential developer. Okay. So they're growing the leasing business, and from 2018 to 2023, this leasing business will be growing by annual growth rate of around 18% on the average. Okay, and Another reason why we are very excited about Philinvest is because of its massive investments in Clark City. So it has Philinvest Mimosa and Philinvest GAIA. So in particular, Philinvest GAIA is around 200 hectares. So that's a big land bank, and they have very exciting plans about this. And for those of you who are aware, the land prices in Clark have actually been going up substantially. They should benefit from this investment. And earnings growth to be quite rapid, more than 10% the next few years. And the best part is this stock is trading at a very cheap valuation. It's actually trading below book value, meaning you're buying it cheaper than their own purchase price of the properties that are in their books. Okay, in terms of PE, it's 7 times PE. The peer average is 21 times. So this is the average PE of property stocks in the Philippines. 21 times, you're only trading at 7 times. And for those of you who are looking for yields, they even provide a dividend yield of 3.2%. Okay, so this is a stock that is easy for you to be patient with, no? Kasi habang naghihintay kayo, kahit volatile siya, it provides a 3% dividend yield, no? Okay, the next stock that we will add, or that we are adding just today, is CNPF, or Century Pacific. So this is the company that manufactures and markets Century Tuna. But less known is the fact that they also manufacture and distribute birch tree milk powder. And, you know, surprisingly, I didn't even notice, they said from a 2% market share, or the reason why we like it is birch tree milk powder, because from a market share of 2%, birch tree milk powder has a market share now of 18%. That's a huge jump. And we're talking about a 40 billion peso market versus the tuna market, which is a 15 billion peso market. So it's really very exciting. Earnings of, or at least sales of birch tree actually grew by around 50% the first quarter. So this is a very favorable growth driver for the company, which is why we're really excited about it. And it looks like, you know, this growth is sustainable going forward. Okay, tuna business. The prices of tuna have actually gone down to a 3.5-year low of $1,000, I think, per ton. No? And this should benefit CNPF through higher margins, which the company plans to use to boost advertising spend, to grow the business and to maintain their strong brand equity. As for earnings growth, you can see we're anticipating very strong earnings growth the next 2 years, compounded annual growth rate of around 17%. And the best part is, you know, it's an unloved stock trading at around 17 times PE. The peer average 24 times. Our beloved Jollibee is trading at 30 times. So for us, it's really a very good stock pick. Okay, so in summary, we believe that the Philippine bull market will continue as factors that hurt performance last year, such as inflation, interest rates, and the peso, even foreign fund outflows, have reversed to our favor. Aside from falling inflation, we feel like the BSP has more room to loosen its monetary policy given a more dovish Fed. And the government has finally passed the delayed 2019 budget, which is also another good news for the Philippines and should help GDP growth recover in the second half of the year. Finally, valuations of the stock market remains very attractive. However, we feel that the bull market will be very volatile going forward. Okay, global economic outlook remains poor, and although central banks globally are losing their monetary policies, it remains uncertain if this will be enough in addressing global economic slowdown concerns. Domestically, the Philippines will continue to suffer from an above-average budget deficit and a current account deficit. And these were the factors that were responsible for the weaker peso in 2018. Okay, and in the short term, we also have the MSCI rebalancing and a potentially weak second quarter earnings season. Okay, given expectations of heightened volatility, we advise investors to manage size, although you should stay invested Just don't be too aggressive. Manage your size and invest only long-term money and focus on attractively valued stocks. So at this point, there's no reason why you should be chasing stocks. And our top picks include Ayala Land, Mega World, Philinvest, Metrobank, Security Bank, DNL, SSI, Maxis, CNPF, and Ayala Corp. So for those stock picks that are already expensive at this stage, wait for pullbacks to buy them. So with that, thank you very much.